There's a particular moment in Charlie Munger's reflections that slices through the myths we like to tell ourselves about genius and greatness. I have a good mind, he shrugs, but I'm way short of prodigy. And yet here he is, someone whose results in life are unmistakably prodigious. What gives? The answer, he says, is a simple one. He learned the right tricks. To investment analysts who spend their days buried in models, macro outlooks, and market noise, this revelation should be electrifying. Because if Charlie Munger is right, the difference between mediocrity and greatness isn't superior intelligence or elite pedigree. It's having a robust toolkit of mental models, tricks, really, that sharpen your perception, clarify risk, and guide action. And if you pick them up early, as Munger did, they compound over time like capital itself. Munger's favorite mental tool is inversion, the habit of thinking problems backward. As a weather forecaster in the military, he didn't ask, how can I predict safe flying conditions? Instead, he asked, what's the easiest way to kill these pilots? That grim framing wasn't cynical, it was practical. It led him to focus on the two fatal risks in his jurisdiction, icing and fuel exhaustion. Everything else was noise. This mental reversal, start by asking how something fails, has direct applications in investing. Instead of asking, how can this stock go up? A great analyst might ask, how does this blow up? It's the same logic behind reverse DCFs. Don't ask what a company is worth, ask what needs to happen to justify its price. It's how you spot implausible assumptions hiding in plain sight. Another Mungerism, dimensional thinking, emerged in a real estate dispute. An elderly appraiser insisted on valuing easement damage using two-dimensional comparable land sales. Munger, spotting the fallacy, reframed the problem. The real cost wasn't acreage lost, it was elevation frozen. With the transmission towers in place, the developer could no longer move earth from peaks into valleys. He'd lost not flat land, but the potential for profitable regrading. The investment lesson is profound. Think in the right dimensions. In equity analysis, this might mean moving beyond PE ratios and spreadsheets to think in strategic, behavioral, and operational layers. What's locked in or frozen by regulation? What strategic options are now unavailable due to competitive moves? If you miss the third dimension, you miss the real economics. When Munger and Buffett orchestrated the Occidental Anadarko deal, they didn't drown in data rooms or outsource due diligence to armies of analysts. They acted quickly because the key facts were already evident. The Permian Basin is the most prolific oil reservoir in the US. The deal structure gave them a preferred return plus upside, and the management team had proven engineering acumen. Done. For most analysts trained in institutional risk aversion, this sounds dangerous. Shouldn't we know everything before committing capital? But Munger argues the opposite. If you're 96% sure, that's all you're entitled to. Beyond that lies the realm of insecurity masquerading as diligence. This isn't an argument against research, it's an argument against overfitting. If a thesis rests on 20 layers of assumptions, it's probably not robust. Great investors don't seek total certainty, they seek enough certainty to act decisively, then size positions accordingly. Munger's ROT training gave him another metaphor, bracketing. Fire one shell long, one short, then adjust. This echoes the iterative spirit of sound forecasting. Don't aim for perfect precision up front. Instead, test, bracket, and refine. In practical terms, this means scenario analysis. Suppose you're analyzing a leveraged buyout. One model assumes cost synergies come through, another assumes zero. What's the IRR spread? Or in valuing a growth stock, how much revenue growth must occur to justify the current EV to EBITDA multiple? What if margin expansion fails? The key is to pressure test assumptions early and often, not to find truth, but to understand the range of plausible futures. Investing, after all, is a game of distributions. One of Munger's childhood lessons, swim as long as you want, but stay near the shore, has morphed into an investing principle. Define the kill zones early and stay far away. Whether it's unproven management, opaque accounting, or geopolitical overhangs, the point is to avoid the obvious disasters. You don't need heroics to outperform, just the discipline to steer clear of folly. For analysts, this means developing a deep respect for non-linearity. Bad things happen fast. Covenants trigger. Liquidity evaporates. Ratings downgrade. And sometimes the difference between solvency and bankruptcy is just one unlucky quarter. That's why the first job of an analyst isn't to be right, it's to not be catastrophically wrong. There's a quiet fury in Munger's critique of modern finance, the endless armies of young lawyers doing due diligence by rifling through purchase orders. It's not that diligence is bad, it's that it's often disconnected from judgment. A person who needs 100 pages of notes to make a call on Easy Corp's business model, Munger implies, probably shouldn't be making that call in the first place. What's missing is epistemic confidence, the ability to say, I know enough, and act, and the courage to admit when you don't. The real skill isn't knowledge, it's knowing which knowledge matters. Munger's bag of tricks, whether inversion, dimensionality, bracketing, or simplification, is not arcane. It's deeply human. Most were learned through observation and failure, not lectures or models. But collectively, they compound into a formidable toolkit. This is what separates great investors from the good. Not just the capacity to analyze, but the ability to see, to invert the question, to recognize which dimension matters, to estimate probability without demanding certainty, and above all, to decide decisively and in time. Charlie Munger never claimed to be a genius. What he mastered was mental leverage, the ability to solve complex problems with simple tools used precisely. If you're an investment analyst looking to sharpen your edge, don't chase more data, chase better questions. Don't memorize formulas. Learn to see structure. And above all, don't wait for perfect information. Learn when 96% is enough. Because in the end, investing isn't about brilliance. It's about clarity. And the right bag of tricks beats a genius IQ every time.